There is a silent threat that thousands of retirees walked into last year without knowing it even existed. They took money out of their IRAs they didn't have to take. They paid taxes on distributions that were not legally required. They accelerated income into a tax year, where it bumped them into a higher Medicare premium bracket 2 years later. And they did all of this because the rule they were following had quietly changed, and nobody called to tell them. The required minimum distribution age changed. For decades, it was age 70 and a half. Then the first Secure Act in 2019 moved it to 72. Then Secure 2.0, signed at the end of 2022, moved it again to 73. And it is scheduled to move again to 75 in 2033. 3 changes in less than 5 years, each quietly reshaping the retirement planning calendar for millions of Americans. Most retirees rely on whatever rule was in place when they started learning about retirement. They internalize it, they plan around it, they mark their calendars. And then the rule changes, and the calendar they marked is now wrong. This video is for educational purposes only, and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. What I want to do today is walk through exactly where the age 73 rule applies, who is safe, who is not, and what the planning opportunity looks like if you just got an extra year of flexibility you didn't know you had. Here is the specific rule, because precision matters. Under Secure 2.0, if you were born between January 1st, 1951 and December 31, 1959, your required beginning date for RMDs is April 1st of the year following the year you turn 73. If you were born on or after January 1st, 1960, your required beginning date is April 1st of the year following the year you turn 75. If you were born on or before December 31st, 1950, you are under the old rules, and your required beginning date was already triggered at 70 or 70 and a half, depending on exactly when you were born. The practical effect is this: if you turned 72 in 2024, or will turn 72 in 2025, you are not required to take an RMD at 72. Your first RMD is due by April 1st of the year, after you turn 73. So if you turn 73 in 2025, your first RMD is due by April 1st, 2026 for the 2025 tax year. But, and this matters, if you wait until April 1st of the following year to take that first RMD, you will also have to take your second RMD by December 31st of that same year, doubling up 2 RMDs into 1 tax year. That can push you into a higher bracket and a higher Medicare premium bracket. Arthur, a retired machinist from Iowa, was born in July 1952. He turned 72 in July 2024. Under the old rule he would have been reading about, he thought he needed to take his first RMD by December 31st, 2024. He called his IRA custodian in November 2024 to arrange a $17,000 distribution. His custodian, to their credit, told him the rule had changed. Under Secure 2.0, because he was born after 1950 and before 1960, his required beginning date is based on age 73. He turns 73 in July 2025. His first RMD is due by April 1st, 2026. He had a full year of breathing room he didn't know about. Arthur ended up not taking the distribution. He did a partial Roth conversion instead, moving $12,000 from his traditional IRA to his Roth IRA, paying tax at his current bracket, and keeping future growth out of the RMD base. That is a fundamentally different financial outcome than an involuntary distribution at age 72. And it was available because the rule had changed. Let me walk through the mechanics of how an RMD is actually calculated, because the calculation itself is worth understanding. Your RMD for any given year is your prior year December 31st account balance divided by a life expectancy factor from the IRS Uniform Lifetime Table in Publication 590B. At age 73, the divisor under the current Uniform Lifetime Table is 26.5. So if your IRA had a December 31st balance of $500,000, your 73-year RMD is $500,000 divided by 26.5, which is roughly $18,870. The divisor changes every year. At 74, it is 25.5. At 75, it it is 24.6. At 80, it is 20.2. At 85, it is 16. At 90, it is 12.2. The older you get, the smaller the divisor, which means the larger percentage of your account the RMD represents. At 73, the RMD is about 3.8% of the account. At 90, it is about 8.2%. If your spouse is more than 10 years younger than you and is your sole beneficiary, you can use the joint life and last survivor expectancy table instead, which gives you a smaller RMD. For most retirees, this doesn't apply, but for some, it is meaningful. The RMD applies to traditional IRAs, SEP IRAs, simple IRAs, and most employer-sponsored retirement plans, including 401(k)s, 403(b)s, and 457(b)s. It does not apply to Roth IRAs during the account owner's lifetime. Under Secure 2.0, starting in 2024, RMDs also no longer apply to Roth 401(k)s during the account owner's lifetime, which aligned Roth 401(k) treatment with Roth IRA treatment. That was another quiet change most retirees never heard about. If you are still working past age 73, and you do not own more than 5% of the company you work for, you may be able to delay RMDs from that specific employer's 401(k) until you actually retire. This is the still working exception. It does not apply to IRAs. It applies only to the plan of your current employer. If you have an old 401(k) from a former employer, that one is subject to RMDs once you hit your required beginning date, regardless of whether you are still working elsewhere. The penalty for missing an RMD used to be 50% of the amount you should have taken. Secure 2.0 reduced it to 25% and further reduced it to 10% if you correct the missed RMD within a correction window, generally 2 years, and file Form 53329 to report the shortfall and request a waiver for reasonable cause. The IRS has historically been willing to grant waivers for genuine mistakes, but you do have to file Form 53329, explain the circumstances, take the missed distribution, and ask for the waiver. The penalty is not automatic forgiveness, so here is the planning opportunity that Secure 2.0 created, and that most retirees are not using. If you are between the old RMD age and the new RMD age, you have a window of reduced required income. That is exactly the window where strategic Roth conversions become most powerful. Every dollar you convert from traditional to Roth while you are in a lower bracket is a dollar that will never be subject to an RMD again. It will never be forced out of your account against your will. It will never push your Social Security into the taxable zone. It will never spike your Medicare IRMAA. It will grow tax-free and pass to your heirs tax-free under the current rules. Ruth, a retired accountant from Pennsylvania, turned 72 in 2024. Under the old rule, her first RMD would have been approximately $24,350 based on her traditional IRA balance of $625,000. Under the new rule, she has no RMD in 2024. She worked with her CPA and executed a $35,000 Roth conversion in 2024, spread across 2 payments. She paid federal tax at her marginal 22% rate, roughly $7,700. Her 2024 Roth conversion removed $35,000 from her future RMD base. Over the next 15 years, at an assumed 4% growth, that $35,000 becomes roughly $63,000. None of it will be subject to RMD. None of it will be federally taxed when withdrawn, and it passes to her 2 adult children as a Roth, where, under current rules, it can grow for 10 more years before full distribution is required. The planning benefit is substantial, and it was possible only because the RMD age shift gave her a clean year to execute. Let's talk about the pitfalls that come with the transition, because they are real. The first pitfall is doubling up. If you delay your first RMD until April 1st of the year after you turn 73, you will have to take your second RMD by December 31st of that same year. 2 RMDs in 1 tax year. That can spike your income significantly. For most retirees, the better move is to take the first RMD in the calendar year you turn 73 by December 31st, so that only 1 RMD lands in each tax year going forward. The second pitfall is forgetting which tax year an RMD belongs to. The RMD for the year you turn 73 is tied to your December 31st balance of the year before. The physical distribution can happen any time before your required beginning date. If you take it in January, it counts for the prior tax year only if certain conditions are met. In most cases, a distribution taken in January of 1 year counts for that year, not the year before. The paperwork has to be clean. The third pitfall is multiple accounts. If you have several traditional IRAs, you can aggregate the RMDs and take the total from any one of them, or split it across them. For 401k or 403b plans, you cannot aggregate. Each plan's RMD must be taken from that plan separately. Retirees who have consolidated their old 401ks into IRAs have an easier time. Retirees who haven't often miss one plan's RMD entirely. The fourth pitfall is qualified charitable distributions. If you are age 70 and a half or older and you want to donate to charity, you can use a qualified charitable distribution, or QCD, from your IRA. The QCD counts toward your RMD and is excluded from your taxable income. The annual limit for 2024 is $105,000, indexed for inflation going forward under Secure 2.0. This is a powerful tool for charitable retirees because it lets you satisfy your RMD without increasing your adjusted gross income, which protects your Social Security taxability and Medicare IRM 80A. But the QCD must go directly from the IRA custodian to the charity. If the check passes through your personal account, it doesn't qualify. Nancy, a retired nurse from Minnesota, had been writing annual checks to her church, about $6,000 a year, after receiving her RMD. Her CPA pointed out that she could instead have her IRA custodian send $6,000 directly to the church as a QCD. That $6,000 would satisfy part of her RMD without increasing her adjusted gross income. Her adjusted gross income dropped by $6,000, which kept her below a Medicare ARMA threshold she had been hovering right above. The savings on Medicare premiums alone was roughly $700 for the year, on top of the tax savings from the lower AGI, a structural change with no change in actual giving. The fifth pitfall is beneficiary rules. If you inherit an IRA, you have RMD obligations that are entirely different from the original owners. Secure Act 2019 introduced the 10-year rule for most non-spouse beneficiaries. Under the final regulations issued in 2024, most non-eligible designated beneficiaries have to take annual distributions within that 10-year window, not just empty the account at the end. Spouses, minor children, disabled individuals, and those not more than 10 years, younger than the decedent, are eligible designated beneficiaries with different rules. These inheritance rules are their own topic and worth a full conversation with a professional, because the penalty for misunderstanding them is steep, and the rules changed meaningfully as recently as 2024. Let me give you a clean action checklist if you are in the window. If you were born between 1951 and 1959, verify your specific required beginning date. It is April 1st of the year after you turn 73. If you turn 73 in 2024, your first RMD is due by April 1st, 2025. If you turn 73 in 2025, your first RMD is due by April 1, 2026, and so on. Check every retirement account you own. Traditional IRA, SEP, simple, old 401k from a former employer, 403b from a school or hospital, 457b from a government job. Each of these has its own RMD calculation. Know the total. Estimate your RMD amount. Use your prior year, December 31st balance and divide by the Uniform Lifetime Table factor for your age. The table is in IRS publication 590B. Your custodian will also usually calculate and display this for you on their statements and online portal. If you have years before your required beginning date, because of the rule change, consider strategic Roth conversions in those years. The window between when you retire and when RMDs begin is often the lowest income period of your retirement and the best opportunity to convert at favorable rates. If you are charitably inclined, consider QCDs once you are eligible at age 70 and a half. The QCD counts toward the RMD and excludes the distributed amount from AGI. Plan the timing of your first RMD to avoid doubling up. Taking it in the calendar year you turn 73, rather than waiting until April 1st of the following year, is usually cleaner. Update your beneficiary designations. RMD rules for inherited accounts change significantly, and an outdated beneficiary designation can cause the wrong person or the wrong trust to inherit, with potentially accelerated distribution requirements. File Form 5329 promptly if you discover a missed RMD. The reduced 10% penalty for timely correction is significantly better than the 25% for delayed correction. Coordinate RMD planning with Social Security claiming, pension election, Roth conversion strategy, Medicare IRMA thresholds, and charitable giving. These are not separate decisions. They are a single integrated plan, and the RMD age change ripples through all of them. The bigger picture is that the retirement rulebook has been rewritten twice in 5 years. The Secure Act of 2019 moved the RMD age from 70.5 to 72, eliminated the stretch IRA for most non-spouse beneficiaries, and raised the age to contribute to a traditional IRA. Secure 2.0 in 2022 moved the RMD age to 73, and eventually 75, lowered the missed RMD penalty, indexed the QCD cap, allowed simple and SEP Roth contributions, and changed Roth 401k RMD rules. Dozens of provisions are still phasing in over a 5-year window from 2023 to 2027. Most retirees are not following these changes in real time. They rely on advisors, CPAs, and custodians to flag things. Most advisors are flagging correctly, but communication gaps happen. A good move is to check in annually with a qualified professional, even for a brief hour, to confirm that your RMD calendar matches the current rules for your birth year, and that your planning for Roth conversions, QCDs, and beneficiary designations is up to date. The cost of being wrong is not abstract. A missed RMD, an unnecessary distribution that spikes a Medicare premium, a Roth conversion done in the wrong year, a charitable gift structured as a check instead of a QCD. Each of these can represent thousands of dollars in unnecessary tax or premiums over a retirement. The cost of being right is usually one phone call and a few thoughtful decisions each year. Let me close with one more practical example that ties several of these pieces together, because the integrated view is often the most useful. Walter, a retired accountant from Nevada, was born in 1952. He retired at 65 and had spent the 7 years since then living mostly on his Social Security, plus a modest pension from a regional firm where he had been a partner. His traditional IRA had grown to approximately $800,000 at age 72. Under the old rule he had read about years earlier, he would have started RMDs at 72, approximately $30,000 for his first year. Under Secure 2.0, his required beginning date shifted to age 73, giving him another year of flexibility. His CPA reviewed the situation and recommended a coordinated strategy. In the year he turned 72, with no RMD required, Walter executed a $40,000 Roth conversion at his 22% federal marginal rate. The conversion cost him approximately $8,800 in federal tax, with no state tax because Nevada has none. In the same year, he verified his beneficiary designations on all retirement accounts, updated his estate documents, and set up qualified charitable distribution instructions for his IRA custodian, so that the following year's RMD could be partially satisfied through direct charitable transfers. At 73, Walter took his first RMD of approximately $31,000, with $10,000 of it directed as a QCD to his church and a local community college scholarship fund. The $21,000 taxable portion added to his existing income kept him in the same bracket he had been in. The $40,000 he had converted the prior year was now growing tax-free in his Roth IRA, with no future RMD obligation. His marginal tax situation was stable. His charitable giving continued at the same level, but with a more favorable structure, and his estate planning was current. This kind of integrated approach is available to most retirees who are willing to plan a year or two ahead rather than reacting to each tax year individually. The rule changes of Secure 2.0 expanded the window for exactly this kind of planning, and the retirees who use the window are often the ones whose lifetime tax bills are meaningfully lower than their neighbors with otherwise identical finances. If this walkthrough gave you a clearer picture of where you stand, On the new RMD rule, here is a small favor that helps this channel grow and helps more retirees get accurate information. Hit the subscribe button and tap the bell so the next video on Social Security timing, Medicare RMD, and Roth conversions gets to you directly. The more retirees who subscribe, the more weight the platform gives to getting this kind of specific, accurate information out to people who need it. Thank you for spending this time with me, and be well until we talk again.